All right, thank you, Chrissy, and welcome everybody to our OPEB deep dive. This is year 2 talking about OPEB. Last year we talked a little bit about GASB 74, but today we're going to focus primarily on GASB 75. So we're excited to have the opportunity to go through this webinar with you. So my name is Melissa Galesso. I'm a director in the Audit Professional Practices Department at Bekaert, and I sit in the Charlotte office. But more importantly with me today is Greg Miller. Greg, can you introduce yourself to everyone?
Hi, good morning. I'm Greg Miller. I'm a senior manager in our Governmental Services Group, and I'm based out of our firm headquarters in Richmond, Virginia.
Well, we are very appreciative of you taking time out of your schedule to go over some of these changes with us. So let's dive on in here with our first polling question. We just like to know who we have here on the line, and so what type of governmental entity do you represent? And so just to get a little bit of a feel for who we have, as that does have an impact on our OPEB, so we wanted to kind of see what you guys were representing here. So what type of plan, or what type of entity do you represent? Are you a public school or university, including our K-12, obviously, schools? City, county, town? Are you from the state? Are you from an authority, board, or commission? Some other type of governmental entity, or are you not a governmental entity? So for those of you who are not from a governmental entity, or you are from a other governmental entity, let us know what type of entity you are from. So in the chat pod, which is on the right-hand side here towards the bottom, just tell us a little bit about what type of entity you are. So we have a city. There is some similarity with what we did last time. We are going to cover some of the changes in the implementation guide. So it is, and it's a new year, so we're going to be covering some new stuff in here. So for those who attended CPE from last year, there are some new items in here. All right, so we've got some private colleges here. We've got a consultant. We have some information from a water and sewer. We've got a library district, a medical university. We've got a lot of really important people on the line today. Greg, are you excited?
I am.
All right, well, let's end that poll and broadcast the results. And let's see what we got here. So a vast majority are from a city, county, town, which is what we would expect for today. And then we have a large number of public schools and universities, as well as the state and the non-governmental entities coming in right in behind that. So excellent. Glad that you are here with us. All right, let's head into the materials today. And we are going to do some review of the 74 information as well as some review what we did last year for 75. All right, so let's dive on in here. So let's talk a little bit about 74. This is something that some entities had to deal with last year, but not necessarily. So Greg, can you tell us what 74 was about and why some people did or did not have to deal with this?
Sure. So GASB 74 is the financial reporting for OPEB benefits that are not pension plans, and it applied specifically to those plans. It didn't apply to the actual governing body that had the employees. It was issued in June of 2015 and was effective last year for fiscal years beginning after June 15, 2016. And unlike pension plans that are most often independently governed and staffed, kind of turnkey entities, trusted OPEB plans are more often administered by those sponsoring employers. So there's a little more legwork last year, if people recall, from implementing GASB 74 of coming up with the journal entries and the disclosures themselves versus relying on some of those state pension plans that are out there that did a lot of that legwork for the implementation of GASB 74 as it relates to pensions.
All right, and again, one of the biggest differences between pensions and OPEB is that one of the things that we tend to see is that there's a lot of trust set up for pensions, not necessarily for OPEB. So that could have been another reason why last year was a little bit different for you, in that implementing it, if you didn't have a trust fund set aside, was a little bit less work for Ben, but obviously 75 coming in right behind it with a lot of the work. All right, so let's talk GASB 75 now, and obviously this is for the employers reporting. Can you give us a little bit of an update here?
Yeah, so GASB 75 was issued at the same time back in June of 2015, and it's effective for years beginning after June 15, 2017. So that's this fiscal years ending 6/30/18. Again, it addresses the employer report, not the plans reporting. It addresses both the OPEB plans that have assets in the trust as well as those that don't. For some of you may recall when GASB 67 and 68 relating to pensions was implemented, there were multiple subsequent GASB pronouncements that modified some of those items within 67 and 68. For example, GASB 71 and 73. I think in total there were 5 different edits to those pension pronouncements, and a lot of those lessons learned from implementing 67 and 68 were implemented into GASB 75.
All right, excellent. So yes, as we talked about, there are differences between the types of funds here that we're dealing with, and so what we're going to focus on today is giving you a pretty good overview, and we're going to get some information from you guys so that we can see what types of plans that you're in and what we're going to do. But let's talk a little bit about 74 and 75 in terms of just a little background on what is OPEB and how does it compare back.
Sure. So OPEB primarily relates to the health care benefits that are provided to retirees. Those are sometimes provided through pension plans or separate plans. But if you were to have a pension plan that provides health care benefits through the pension plan, those would be separate OPEB plans. But if you have other benefits such as life insurance or other benefits that are provided by the employee to retirees, those are not included in the OPEB plans.
Right, and so I think this can get very confusing for people. So if you have let's just do, so you have medical, dental, vision. It doesn't matter whether it's in a pension plan or not. 74 and 75 apply. But when you get into the other types of OPEB, then if it's in a pension plan, you're going to follow the pension standard. But if it's not in a pension plan, then you're going to follow the OPEB standard. So you really have to understand what your plan includes so that you can determine whether you should be applying 67, 68 versus 74, 75. And we know some states last year actually had some restatement issues because they had included some of their OPEB in their pensions, and then they realized that when the the OPEB standards came out, they actually had to undo what they had done because they hadn't made that separation. So we should be very careful to understand our plans. It feels and looks very similar. However, there are unique differences between them, and so we're going to focus today on a lot of those items. So let's talk a little bit about the plan here. So what do we deal with when we have a trust versus we don't have a trust, and what does that mean?
Sure. So under GASB 74, when there is OPEB benefits that are provided through a trust or equivalent arrangements, then the plan financial statements are required to be prepared, and they can be issued either separately under their own standalone financial statements, or they can be presented as part of the primary government's financial statements, included in their larger CAFR. The implementation of 74 applies changes retroactively to restate financial statements when possible. Some of those, it also includes RSI tables, and some of those RSI tables we do have the information available to present that information for 10 years. An example of that would be employer contributions. We know what those contributions have been historically, so we can provide that information in RSI. However, other RSI required tables, we haven't had that information, so we would include that information starting with 74 and then build that 10-year table over time.
All right, so again, that would depend on what information is available. The GASB did not want to ask us to do things that we could not do, and so they made those, well, if you don't have the information, you would just develop the information over time. Now, as we said, 74 and 75 are different from 67 and 68 in that 67 and 68 only applied if you were in a trust. 74 and 75 have both trust and non-trust guidance. Pensions had to wait until 73 came out before they had guidance for those that were not in a trust. So when we're thinking about this, when we do 74, it did address those items that were not in a trust and proper presentation of those, whether or not you had a trust. And so you had to have adjustments last year regardless. So let's talk about the type of plan. I think this is something that people really struggle with, that trust versus no trust. So we want to make sure that we are able to understand what the requirements are when you have a trust versus you don't have a trust.
Sure. So within an OPEB plan, you're either in a trust or equivalent arrangement or not in a trust. And those that are in a trust or equivalent arrangement are required to issue financial statements. There's three different types of plans that fall under this. A single employer, so that's when there's one employee within that trust, and it can include the primary government as well as its component units and still be a single employer. The second type of plan is a multi-employer agent plan. This is a plan in which there are legal separate accounts that track the fund for each individual employer. And then the third type is that multiple employer cost-sharing plan, which is similar to the multiple employer agent plan. However, there's not a legal separate account for each individual employer, and all those assets within the trust are commingled to pay the benefits out to all employees of all employers. If we're not in a trust or don't have an equivalent arrangement, there are two types of plans, and that is the single employer and then primary governments and component units. And they are not required to prepare financial statements.
All right, and so as we go through this, I think what we have to remember is for a single employer, it's just you. So if it's you and your component units primarily, then all of the work is done by the single employer. So what we see in a lot of states is where they participated in that cost-sharing plan of the state for pensions, and they might need me for an OPEB plan sitting as a single employer. So all of the accounting is now having to be done under the single employer requirements as opposed to the cost-sharing. So we do have to pay attention to that information as we go through it. So we have to make sure that what we're doing is we're segregating what the requirements are and whose responsibilities we have. And so today we're going to focus a little bit on that responsibility. If you're not in a trust, right, what we have to deal with there is that when we don't have any financial statements, we do have possible assets that have been set aside that are not in a trust. And so we'll have to deal with those assets that have been set aside, not necessarily in a trust that meets those requirements. All right. So back in 2017, we had an implementation guide come out, and it was specific to OPEB, but it was specific to GASB 74. So what was some of the implementation guidance that we received in 74?
Sure. So there was a lot of guidance in there. It's about 118 pages long. We're not going to read through 118 pages of questions and answers as it relates to 74, but one of the common questions relates to pay-as-you-go OPEB plans. So some plans are pay-as-you-go. They're unfunded but still administered through a trust. And the question was, does 74 still apply to those type of plans? And the guidance within this implementation guide was yes, 74 is still applicable, and it's applicable regardless of the timing of the contributions or that funding status. So that was a big question last year when we were implementing 74. So hopefully we've gotten through most of those hurdles to date.
All right. A lot of what we just talked about in terms of whether something was in a trust, there were a lot of questions about what was an equivalent arrangement that was addressed, as well as what the standalone financial statements would have to look like and incorporate. What were some of the issues that they dealt with regarding clarifying benefits?
Sure. So the most common question that popped up from this perspective were health insurance supplements. So say an OPEB plan sets a dollar amount that retirees would receive monthly, but there's no stipulation on how that retiree spends that supplement dollars, that extra dollars upon retirement. And the guidance from this implementation guide was that this doesn't meet the definition of GASB 74, and that additional funding to the retiree upon retirement would be treated as pension income and not as OPEB benefits.
All right. So again, when we're looking at what other things, when we talk about healthcare is very clear, always going to be 74 and 75. It's those other items like disability, workers' comp, that was a little bit more complicated and we had to pay close attention to. So we want to make sure that when we step back from this that we realize that the implementation guide is considered authoritative guidance. And so it was approved. It went through a due process comment period. And so when these questions and answers come out, it's vital that people read the question and answer because it clarifies some of the things that are not necessarily clear in 74, and then when we get to 75 again, we're going to address some of those items very specifically. So we want to make sure that we're reading the implementation guide and seeing if any of those questions apply to our organizations. All right, so again here, when we talk about the types of plans and the financial statement, what sort of questions came into GASB?
Sure, so for this regard, there was a good example of a question was an OPEB plan in which an employee contributes 7% of their salary to a specific employee account. And those assets within that specific account were stipulated to be used for health care costs. That account accrued interest at 5% less any admin fee associated with maintaining the trust. And then at retirement, the employee draws down from their specific account, and then that account continues to accrue interest on 5% throughout the retirement period. So the question that came up was, is this a defined benefit plan or is this a defined contribution? And the guidance has 3 requirements to be a defined contribution plan. And the first one is that there's an individual account for each employee, which this example fits. The second requirement was that the plan determines the level of the employer contribution. So this example meets that requirement as well because there's a 7% employee contribution. The third requirement is that the OPEB benefit received by the retiree is only from the employee's contributions and any actual earnings that those assets earn. So this example doesn't meet that third requirement because the interest rate that was being earned on the assets was set at 5% of the plan. It doesn't match the actual percentage. So in this example, we would have a defined benefit plan.
All right, so yeah, so as you can see, they were trying to answer some of the very specific questions that come up. And so a lot of times I just enjoy reading through them to see what some of the issues that other people had, to see if that overlaps with any of our clients or any of the things that we were considering as we go through. So I would highly recommend a good review of the implementation guide. All right, so based on what we just shared, we have a poll question for you regarding what type of OPEB plan do you have. And so we're going to ask if you have a single employer, agent multiple, cost sharing, you're not sure, you don't have an OPEB plan, and just to let us know what type of plan that you are going to have. And then if you want to let us know in the chat box, let us know what state you're from. So we're kind of looking to see how your responses share back, because some states are all single employers, some still have cost sharing. And so tell us a little bit about who we have on here. So we have from Florida, Georgia, from North Carolina, my home. Your home's on here, Virginia, a couple times. From South Carolina's in here. Hello to Louisiana. Let's see, who else do we have? Maryland. Alabama, welcome. Florida. Wow, we've got some good mix coming in here. From Georgia, welcome Georgia. Oh, some people are going to be really excited. They have a single employer, multiplier, and cost sharing plans. Whew, you got a lot ahead of you there. That sounds like fun. Oh, we have someone from Charlotte, North Carolina, literally just down the street from me. Got some more Virginia and North Carolina. So it looks like we have a good mix on. We actually have Missouri. I think that's the furthest I've seen so far. Beautiful. So let's broadcast these results here and take a look at them. I am not surprised by the outcome one bit, though. So it looks like over half of you have a single employer plan, and that is exactly what we were going to expect. I thought it'd actually be a tiny bit more, but there is 8% of you that don't have an OPEB plan and 14% of you that aren't sure. So that really probably helps out with that number system there. So a single employer being well over half of them. And then we have some cost sharing multiple and agent multiple in there. And then some of you said you have multiple types of plans. So very, very exciting attributes going on there. So this is pretty much in line with what our expectations were. So, and if we were to ask you the opposite, if we were to ask you what you did for pensions, we would bet that the vast majority of you would come from a cost sharing plan. So you're going to have some differences as you go through this. So let's talk a little bit about the employer standard on GASB 75 and some of the things that we need to think about in terms of what we're going to do going forward.
Sure. So the employer standard for GASB 75 is very similar to that of GASB 68 from the pension side, however relating specifically to OPEB. We would apply these changes retroactively to restate the financial statements for all periods presented. Most localities present 1 year, but if we did have comparative financial statements, we would need to restate the earliest period shown within the financial statements. But when it's not practical, some of the areas that are not practical relate to the deferred outflows and inflows of resources at the beginning of the period. Some of those deferred outflows and inflows are known, similar to my comment earlier that the RSI tables for contributions known that for a historical 10 period of time. We would know what the contributions made subsequent to the measurement date were. So those deferred inflows and outflows of resources would be practical to have to restate at the beginning of the earliest year presented.
All right, and so basically the concept very similar to what we had as an amendment to GASB 67 and 68 was they want you to show anything that are after the measurement period because that concept of what you can choose in terms of your opening balance, they really want to see those that are after the measurement date, and so that's not an option. So that was a separate standard when we did pension, but they were able just to include that language when they issued the OPEB standard. All right, so let's talk a little bit about what our opening adjustment would have to look like in order for us to get this onto the books.
So to bring on that net OPEB liability in the first year, we'd have to offset that against the beginning of year net position. Then we would record the deferred outflow for contributions after the measurement date, with the offset again being net position, the common trend here in these journal entries. And then the last piece would be to eliminate that GASB 45 net OPEB obligation. Since we brought on that new liability in the first entry, we need to back out what we have already been reporting as that net OPEB obligation, again offsetting against net position.
And so basically the concept here is we want to start with a clean slate. So we'll be bringing on whatever our opening net position is, but we don't want to confuse it with our old value. And so GASB literally had to come up with new terminology in 67, 68, 74, 75 to differentiate the actuarial terminology, the funding terminology that we were used to, and switch to what we would consider to be financial reporting. So they really had to do a pretty good adjustment, and they actually had to create new terms to differentiate between what we consider to be actuarial terminology, because we no longer are using it for funding, we're using it for financial reporting, and we're distancing ourselves from a funding mechanism to an accrual accounting concept. All right, so what are some of the big differences that we're going to notice as we walk through this?
So the first one is the net or total OPEB liability, which is now recorded in the financial statements. Prior, we had the net OPEB obligation. Also, under 45, there used to be multiple ways or actuarial methodologies and discounting guidance that we could use to determine what that total OPEB liability is. But GASB 75 strictly prescribes what those methodologies and that guidance is, which will most likely result in higher liability amounts for OPEB plans. There's also annual measurement dates that are now required using either annual or biannual valuations. Under 45, there used to be a triannual valuation, which is no longer permitted under GASB 75. And then expense volatility is also, that's likely due to claims volatility, discount rates, and more frequent changes in that underlying plan, how those are allocated throughout the time period, changes in 75 versus 74. And then also 75 has significantly more RSI and note disclosures required within the financial statements.
So when we were using our actuarial calculations, when we were using a funding mechanism, we were able to use any approved actuarial methodology, and there's actually 6 methodologies approved under the actuarial sciences. They're called the ASOPs, the Actuarial Standards of Practice. And so the ASOPs have a bunch of different actuarial items. In order to have consistency, they switched by GAAP and required one of them to be used when we're using it for financial reporting purposes. And so if you were using the entry age normal, not going to be a big impact. But if you were using like percent units credit, that's going to have an impact on how we are basically spreading some of this cost out. And then obviously the expense volatility. Before, if we were using a discount rate based solely on our rate of return, there wasn't as much volatility as if you now have to use either a blended rate or a much lower rate. If you're not having anything in a trust, that can have a pretty big impact. So these items are really the change from being a cash basis funding concept to an accrual financial reporting concept. So let's talk a little bit about that concept of a trust. We kind of hit on this earlier in terms of we have to determine whether or not we have a trust in order to be able to determine what the proper accounting is going to be. So what are the things that are absolutely required to be in a trust?
Sure. So from the trust standpoint, I think most people have seen that it's in a legal separate trust. And then even if it's not in a trust, we don't have that legal piece of paper saying it's in a trust, there are certain criteria that if we meet those, it's still considered to be in a trust, and that's the equivalent arrangement. And the 3 requirements are here. It's the contributions from employers and non-employer contributing entities to the OPEB plans, and earnings on those contributions are irrevocable, so they can't take them back out after they've made them. The OPEB plan assets are dedicated to providing OPEB to plan members in accordance with the benefit terms. The OPEB plan assets are legally protected from creditors of the employer's non-employer contributing entities and the OPEB plan administrator. And also, if the plan is a defined benefit OPEB plan, those plan assets are legally protected from creditors of the plan members.
And so we saw under pensions that almost everything was in a trust. For the most part, there were exceptions to that rule, but we saw the vast majority of plans being in a trust. For OPEB, we're seeing a lot of the opposite. We're seeing a lot more pay-as-you-go, nothing set aside, no plan set up for a trust, and so a different feel when you get to the financial statements. All right, so let's talk about what we are focused on today, which is the net OPEB liability. How do you calculate the net OPEB liability?
So to start to determine the net OPEB liability, we have to start with the total OPEB liability. And then if you're in a trusted plan, you have the fiduciary net position of that trust to help offset what that total OPEB liability is. And the difference between those is that net OPEB liability. Granted, it could be a net OPEB asset. However, I'm not anticipating that to be the common trend for most entities. Most likely will be a net OPEB liability.
Yeah, those assets can be hard to come by. And for many entities, what happens if they're not in a trust? What would happen to this equation?
So for those entities that are not in a trust, since there's no plan fiduciary net position, there's nothing to help reduce that total OPEB liability. So we would be reporting that total OPEB liability, not the net OPEB liability.
So when you do this, basically total minus 0 equals total. And so that's going to, a lot of what we talk about in terms of that plan fiduciary net position won't be applicable. However, the total OPEB liability is calculated the same way whether or not you have a trust. So we consider this, I always call it the 3-step process, PDA, which is project, discount, and attribute. Why do we do this in terms of calculating the total OPEB liability?
Sure. So the first part is to project what the total cost of those future benefits are that we are providing, those other post-employment benefits, that total liability. Then we have to take that projected amount and discount that back to the present value. Once we've taken that amount, we have to attribute, or in other words, allocate, if I may. and we allocated that to each employer and their years of services to get that spread over their years of service.
Correct. So basically, this is why we're using a financial reporting concept. We are not going to expense the cost of medical, dental, vision for retirees when they're retired. We need to calculate what the cost is going to be. We're going to project that when they are working for us and recognize the expense. And that's sort of the matching principle at play. We don't want to recognize the cost when they're already retired. We want to recognize it when they are working for us and spread it over the period of time that they are working for us. And so that is what makes this such a difficult concept, is that now we have a lot of estimates because we now have to estimate when someone's going to retire. If it's something that they receive until they die, then we have to also predict when they're going to die. Some states actually have it where they only get OPEB until they're eligible for Medicare, and then they would switch over to that. So there's a finite period of time when the age limits kick in for that. So it is very difficult considerations that need to be made. So we're going to walk through project, discount, and attribute in a little bit more detail here. And when we're thinking about projection, what are we trying to think about here?
Sure. So the projection of the benefit payments are required to be based on the claim cost or the age-adjusted premiums approximating what those claim costs will be, and the benefit terms and legal agreements that exist within that OPEB plan the OPEB plan's fiscal year end. Projections of benefit payments should also incorporate the effects of projected salary changes, projected service credits, as well as projected automatic OPEB changes.
All right, and so obviously salary is probably not a huge driver if we're talking about something like health, right? So medical, dental, vision. That's not going to be a particularly interesting because we don't typically charge somebody for their health insurance based on their salary. However, if you're getting into those other benefits like disability, disability can be impacted by those salary changes. And so again, when we're thinking about that projection, you also have to be thinking about what is included in your plan and whether it's being covered by 67 and 68 or 74 and 75. And a lot of times, this is when people get tripped up in terms of making sure that we understand what is included in this plan so that the projection can be adequate. And so the goal here is to think about, okay, how much money am I going to have to pay for medical, dental, vision from the day the person retires, and I'm just going to go with a plan that has a mortality concept, until the day the person dies. So they're eligible to stay on our medical insurance. How much is it going to cost us from the day they retire until the day they no longer require it? When is that, what is that going to cost us? And what do we know, Greg, in terms of the cost of medical? Is it going up or is it going down?
Well, it's definitely not going down. It's steadily going up at a pretty steady pace. Not seeing it going down anytime soon.
No, and so we are now predicting something. So if you have a 22-year-old guy and he's going to retire at age 65, which I doubt that will be the retirement age when he retires, but just assume that he's going to retire 40 years from now, and say he lives to be 85, so he's going to retire at 65 and he's going to live to 85, which again I think is going to be short. We have to predict 20 years of the cost of that medical, dental, and vision, and what it's going to cost in 40 years, and then what the costs are going to be over that next 20-year period. Aren't you glad you're not an actuary, Greg?
I am.
All right, so we want to do, go ahead, we want to do apples to apples, so we need to discount. So what do we use for our discount rate?
Sure. So within 75, we have to use a single blended discount rate, and that rate is determined based upon how much assets are in the trust. So we can use the long-term rate of return, which is what we're projecting to be our rate of return for investing those assets within the trust, and we can use that as long as we have sufficient assets to cover those liabilities associated with the benefit payments. Once we reach the point to where the assets no longer cover those benefit payments, we have to use the 20-year tax-exempt bond rate for the rest of that period. and then we would then blend those two rates into a single blended rate.
Now, if you are not in a trust, as we would expect many of the entities on the phone today to be, what would happen to their rate?
So if you're not in a trust, you don't have those underlying assets to invest, so there won't be a long-term rate of return. So those plans that are not within a trust will have to use the 20-year tax-exempt bond rate, which today that high-quality bond, municipal bond rate is for, you would benchmark that off like a AAA bond or higher.
All right, and so looking at a lot of different states, I kind of did a little bit of a review at what some of the states were using for pensions just to kind of get a feel for what we would see for our OPEB. And a lot of states were using for their long-term rate of return somewhere between 7 and 8% on average. So some were a little bit lower in the 5 and 6. I actually saw one that was using a little over 10, which I was surprised by, for their long-term rate of return. However, what do you think the average would be for a 20-year tax-exempt bond for most of our people on the line? So we had a lot of counties, towns, et cetera. Greg?
Sorry. So for that long-term rate, it's probably more the mid-3s, definitely less than 4%. So you're going to see a significant increase in what that liability is if you don't have that long-term rate of return. Even if 7 to 8% is obtainable, using a 3.5 to 4% discount rate is going to significantly increase the amount of liability for those OPEB benefits.
Absolutely, and that's really one of the big drivers here. So if you are not in a trust and you're only using a 20-year tax-exempt bond, that discount rate is very, very low. All right, then we need to attribute. So what is attribution and why do we do this thing?
Sure, so attribution is the process to allocate or to match expenses for those OPEB benefits over the working life of the employee. As mentioned earlier, GASB 74 and 5 dictate what that actuarial method is, and that's the entry age normal. So 45 allowed multiple different methods to be used. I believe there's 6 in the actuarial sciences, 6 different methods that could be used. But in order to create some consistency from locality to state to authority boards and commissions and year after year, GASB has picked one of those methods that everyone must be using to attribute their OPEB benefits. And then there's also the level percentage of pay, or it has to be done on a level percentage of pay, and then it's based on employee by employee. So when your actuary is performing their valuation, they're going to attribute that benefit for each individual employee over their service life.
Which is why census data is so important, because garbage in, garbage out. If you don't tell them the right age, the right start date, the right retirement date, the right information regarding male, female, then they're not going to do this properly. And so one of the biggest changes is the requirement to use that entry age normal as opposed to one of the other options. And entry age normal kind of is a more deliberate spread. So the different concepts is it's sort of like depreciation. Depreciation, you have, your units of credit. You can do it by straight line. You can do double declining balance. But at the end of the day, you depreciate the same amount. Well, it's the same thing with attribution. We're taking the same amount. We're just spreading it differently. Is it front-loaded? Is it back-loaded? Is it evenly spread out? And that's what really the difference is. And so over the person's useful life or their service period, it doesn't matter. It's at the end of the day, you're going to spread the same amount. It's just how much you're going to get in the front versus the back end for attribution. So I saw a question come in about this and the concept of the measurement date versus the fiscal date versus the valuation date, and there was a statement regarding when the measurement date is the fiscal year end. That's not very common. It is possible to do it, but most entities are not selecting that. So can you tell us a little bit about the 3 dates that are out there?
Yeah, so the first one is the fiscal year end date, and this is also the reporting date, so whether it's the plan's reporting date or the employer's reporting date. The measurement date is the date that we're measuring what those OPEB benefits are, and for a plan, that must match the fiscal year end. From the employer, it can be the fiscal year end of the employer, but it could also be 1 year prior to the fiscal year end for the employer, which is the actuarial, the date in which the actuarial valuation is performed. That valuation date can be up to 24 months prior to that measurement date. So for an example, say we have a fiscal year 6/30/2018, but the plan's date, so the plan's fiscal year is December 31st, 2017, which could be, or which would then be the measurement date for the OPEB plan. The valuation date could be 12/31/17 for the employer. It will be, the valuation date has to be 12/31/17 for the plan. But they could take a valuation date as of 12/31/15 on the employer side and roll that forward to the measurement date. It's 12/31/17. But for that question that you mentioned that came up through the questions out there, it's very uncommon. I only know of one that has the same reporting date, fiscal year end date, as they do for their valuations or their measurement date. So most places I have seen, everything would be 1 year in arrears. So the plan would be reporting the current fiscal year end and would have different actuarial information, would have different numbers for that total OPEB benefit, the deferred inflows, outflows, would be different than the plan's reporting under 74 than what the locality would be reporting under 75. So that can kind of get a little tricky out there, especially if the OPEB plan doesn't issue its own standalone financial statements. If those financial statements and those disclosures are made within the locality's CAFR, then you would have essentially two notes within your financial statements reporting two different numbers if you didn't match the year. So it can get a little confusing for a reader out there, so it'd be imperative to kind of make that distinction so that the reader could see the difference between the plan reporting and the employer's reporting.
All right, and you have to use the plan's year-end as a requirement. So you can't use if your plan year-end and your fiscal year-end are different, you don't have a choice but to have a measurement date that would be different. Now, if your plan and your employer are on the same years, then you're in good shape. And there was a great question that came in about do you have to blend if we're always making 100% of our contributions? It depends. You're less likely to have to, but basically what your actuary is going to do is take each of the years going forward, and they're going to say, what is my value of my plan assets? How much do I have to pay in benefits that year? Do I have enough money in plan assets projected for that year to make payment? If they do, then you get to use the long-term rate of return. But in the year that you have not enough funds set aside, you don't have enough plan assets to make the payment, that's when the crossover occurs, and that's when you have to use a blended rate. So it depends on how good your returns are looking, and as you go forward, the actuary will be able to determine if you have a crossover rate. You might not have a crossover rate if it's a well-funded plan, but there's no guarantees on that. You're less likely to have it, but we couldn't guarantee that you wouldn't have a blend. It looks like quite a few of them are actually using a measurement date equal to their fiscal year end. But the measurement date 1 year earlier. So that makes sense. The measurement date is 1 year earlier is typically what we would expect to see. If you have a plan year end and a fiscal year end that's on the same June or December, 1 year earlier is typically what we expect. All right, so if you are a single or an agent plan, what kind of liability do you put on your books compared to a cost-sharing plan?
So you'd be putting, on a single and agent plan, you'd be reporting the net OPEB liability on your financial statements. A cost-sharing plan has an additional estimate built in there, and that's the percentage of contributions that those are then also adjusted for changes during the year to the plan for the employer. And that amount would be the proportionate share of the collective net OPEB liability. So that's your particular piece of that overall cost-sharing plan.
All right, and so you don't know individually what your particular OPEB liability is because we're not keeping track of how the money is going in and coming out. It's all used collectively. So basically, we calculate the collective liability and then calculate a proportionate share in order to divide that OPEB liability up. So obviously, we go through all this effort in the year of adoption, and we come up with our liability. Does it just stay the same forever?
It would be nice. However, nothing's constant, and everything is always changing. And GASB 75 kind of sets out how we're going to recognize those changes over time. 74 used to have, for some of these, used to have essentially a limited amortization period for this. But 75 recognizes it based upon the type of change. So if you have changes in current period service costs or interest on liability or changes in benefits, those differences will be recognized immediately when those changes occur. For changes in economic or demographic assumptions and the differences between estimated and actual experience, we can defer and recognize those over the average remaining useful life. And that average remaining useful life is that average of service years between employees that they have left to serve as well as the retired employees. I know for some plans that average remaining service life is pretty low, probably about that 4-year mark, which either indicates that there's a lot of employees that are about ready to retire, or there is a significant amount of retirees in there. So if you only had 4 years, you would recognize these changes systematically over a 4-year period. And then the last one, which is the difference between projected earnings and actual experience, that's a set time period, and we would defer and recognize that over a 5-year time period.
All right. So again, because of these changes, we do have to make sure that that we are taking care of this. There's a question that came in. Does GASB 75 make it mandatory to have a planned OPEB financial statement?
Yeah, if it's a trusted plan, then we have to have a set of financial statements for that. Whether the plan issues those financial statements separately or not, that's not mandated. That information can be included within the primary government, the employer that's sponsoring the plan. That information can be reported within their financial statements. But if it is a trusted plan, then yes, that OPEB plan should have financial statements.
And if there's no trust, there's no financial statements really to be worried about.
Correct.
All right. So another thing that can change is specific to cost-sharing plans, and we did have some on the line who have a cost-sharing plan. So what are some of the other things that can change here?
Yeah, so the pieces that are different for a cost-sharing plan is that changes in that proportionate share, the difference between the contributions and the proportionate share. So if you have a cost-sharing plan and there are changes in those two items, then we would defer and recognize those changes over the average remaining service life. Again, most of those are shorter than the 5-year period, so we'll be hitting those expenses earlier and have a bigger impact, but still spreading that over time, not taking all those hits at one point in time.
All right. And so here we've given you just a little bit of a summary. We're not going to go through all this, but some of the difference is between the trust and the non-trust. We talk about the difference between net and total OPEB liability, the present value between the blended rate versus the single rate if you are not in a trust. And so just kind of gives you the information here as a comparison. But we're going to keep moving on here to talk about, for many of you, if you're not in a trust, what are some just of the key takeaways that we want to remind people about?
Sure. So there's kind of two types of plans that are not in a trust. There's ones that use insured benefits and then ones that are not insured. So the use of insured benefits is if we pay our current premiums for health care, and say that's $100 per month for an employee, there'd be an additional amount put on top of that. So, for example, we may be paying $125 per month for an employee to cover the health benefits. That additional $25, the health care or the insurance provider is charging that to help cover the cost from when that employee retires. So when that employee retires, the employee is no longer paying anything, no premiums being paid in from the employer, but the insurance company is now providing those benefits based upon that extra piece within the premium. This type of plan is uncommon. I haven't seen it in practice a fair amount. So if you do have that, there are some unique differences in that. We would expense those premiums and kind of disclose the nature of that insurance arrangement. If it's not in a trust and also not insured, we still follow the similar methodology of what we've been talking about. However, there are some exceptions. We don't record the net OPEB liability. We do the total, since there's no fiduciary net position to offset the total OPEB liability. And that discount rate, you don't get to use a more favorable long-term rate of return. You have to use that AA bond-rated long-term rate of return to discount that liability.
All right, so let's move on now to our next polling question. And here, what kind of impact do you guys expect GASB 75 will have on your entity? So is it going to be a significant impact, moderate, none, or you don't have an OPEB plan, so it doesn't really have any impact on you? So again, just to kind of get a feel for that. Because we're getting close on time, I'm going to move the polling along, but I'm going to leave it open so that you can answer while we move on to the next slide, which is the implementation guide. So this is something that just came out rather recently. So why don't you tell us a little bit about it and some of the questions that it is raising?
Yeah, so the implementation guide is about 248 pages. So if anyone has trouble sleeping, there's a light read for you. There's over 500 questions in there that address accounting and reporting for OPEBs. It's organized by type of OPEB plans, so questions related to cost-sharing plans, for example, they're all grouped together. And many of the questions, though, are very similar to the implementation guide for GASB 68, since a lot of the provisions in 68 are similar to those of 75. However, there are some unique topics that relate to OPEB that don't relate to pensions. And we'll go through a few of those here shortly. And then the last piece in there's also illustrations that can also help governments make the calculations, the journal entries, and disclosures needed to implement the standard.
All right, excellent. And so most people here think it's going to be a moderate impact, followed closely by a significant impact. So clearly, OPEB is going to have an impact on our entities on the line. All right, so let's keep talking here about some of the implementation guidance. As you said, you picked a handful of questions that you wanted to address. So the first one is, how does the substantive plan for financial reporting purposes relate to the written plan?
Sure. So I picked this question because in pensions, we pretty much always have a defined, well-written plan. However, most OPEB plans don't have a formally written plan. So determining that substantive plan gets a little more complicated than from a pension perspective. So if a plan document does exist, that document will probably be our best evidence of what the substantive plan is. However, like I mentioned, most don't have a full and accurate understanding of what the benefit terms are. For example, a plan document may state generally that employers will provide post-employment health care benefits, but they don't specifically describe what the types or what the level of those benefits would be. The employer may have a long-established practice of providing benefits in addition to what is actually written in the original plan document. So if that does exist, that other information should be considered when determining the basis for the projection of benefit payments for financial reporting purposes. That would include other communications between the employer and the employees, what that historical pattern or what that practice in the past has been in regards to the sharing of benefit-related costs with inactive employees.
All right, excellent. Let's take a look at another question that you selected here, which is, when developing an expectation about future changes in healthcare costs, is it necessary to consider the types of benefits that are provided? For example, if the benefit terms includes prescription coverage, should the source used as a basis for assumptions about changes in healthcare considered expected future trends related to the cost of prescription drugs?
Yes, yes, they should. So this is also known as unique from OPEBs from pensions, because OPEBs relate with historical costs. So there's that new disclosure out there for the historical cost rate, the trend rate. So yes, to the extent possible, the expectations about changes in healthcare costs should be based on data developed for groups that mirror the demographic composition of plan participants and the types of benefits to be provided under these terms. So if you do have a prescription or a dental, we should be looking at the expectations for those changes specific to those types of plans.
Well, and that makes sense because clearly there's, prescription trend rate probably looks a little bit different. All right, so then the next one is if the alternative measurement method is used, and again, that is when we have less than 100 active and inactive employees, to measure the total OPEB liability, should any portion of the following be included? And so I'll let you kind of walk through that answer.
Yeah. Again, to kind of point out the differences here, we mentioned earlier in a slide that we have to do, the max we can go is a biannual process. We can no longer do that triannual valuation for smaller OPEB plans. However, there is this alternative measurement method within GASB 75 that is not within the sister pension pronouncements. And as Melissa said, those are for plans that are less than 100 participants, both active and inactive. So if the total of those is less than 100, then we don't necessarily have to have a full actuary evaluation. It uses the same method, but may not require all the necessary assumptions within that measurement. So the answer to this, the short answer is no. If the alternative measurement method is used to measure that total OPEB liability, no portion of these amounts should be included in deferred outflows or inflows of resources related to OPEB. The requirements for 75 to include those portions of amounts in deferred outflows and inflows related to OPEBs are applicable only in circumstances when we are not using the alternative method, when we're using the actual full actuarial valuation.
All right, excellent. And then I think we have a little bit here in terms of what are some implementation guidance that you found helpful for users? And while we do that, if you don't mind, Chrissy, if you could put up the poll.
So one of the most common questions I get are there any examples out there that I can look at to help draft the disclosure requirements for the first time? So within this implementation guide, there are example illustrations out there. Although not necessarily authoritative guidance, they're just kind of presented as illustrations that relate to 75. We would have to tailor those to fit the particular plan. But there are illustrations out there. There's also a little more guidance out here on determining the healthcare rate of return and how to disclose that, determining amounts that need to be presented for single or agent employer required supplementary information. So this is a good area to look at. If you don't read all 200 and some pages of this, these might be some good sections to at least look at when you're taking that first stab at drafting those disclosures.
All right, excellent. And then, as I said, we had one more polling question that we're going to put up here for you so that we can close out today. And that's just how ready do you feel for GASB 75? So very, somewhat, not at all, or obviously it's not applicable to me. And while you're answering that, I want to thank Greg for taking time out of his very busy schedule to participate in today's webinar, and then for Chrissy and the learning group for pitching in to make sure this ran smoothly, and for all of you for joining us. I think we've gotten most of the questions that came in. However, if there were any that we missed, we will comb through some of these questions to answer them. It looks like most of the questions have been answered, but we will make sure that if we missed anything that we get back to you. Otherwise, we want to thank you so much for joining us on this webinar, and as a reminder, we have a GASB update, which we're going to go over all the other ones that have been issued, and then later this year we will also have a GASB leases webinar where we walk through in detail the GASB lease standard that came